Trump and his trade wars. Is there action needed for my portfolio? Trump is back, and so is his trade war. And we are flooded with his threats, especially as far as tariffs are concerned. And you can be assured Europe will be next. You see in the slide, the trade deficit versus Europe is very high. You have them here in comparison. So how much are those countries selling to the US versus buying from the US? The trade deficit, China is still the largest, but it has been shrinking over the last years. And next in line is already the European Union. So we'll definitely also be faced with tariff increases and at least tariff threats. So how bad is the situation? At the first glance, pretty bad. The US is the largest single trading partner of the European Union. Roughly 20% of our exports are sold to the US. Looks bad. But it's not happening in a vacuum. Consider this. If the US puts tariffs of 10% on European goods, our products in the US get 10% more expensive. Well, there's such a thing called currency exchange rate. If the euro depreciates by 10%, gets cheaper by 10%, the price for US customers doesn't change at all. And this is what happened already because of the fear of US tariff increases. We were at roughly 1.12 US dollar per euro last autumn, and now we are back almost to parity. So this 10% tariff increase has more or less already been compensated. But what if Trump does more? 25, 30% tariff increase versus Europe. 20% exports to the US seems a lot. Again, if you look closer, the European Union as a whole does not export so much. Only 20% of our total production in the European Union is exported. And of those, 20% in the US. And of those, only 3/5 are really goods. The rest is services, not in the crosshairs currently. So if you do the math of all this together, the European Union, given all what we produce, is roughly selling 2% of this to the US. Those 2% would be really then affected by tariff increases. That's already a much smaller number. It's not nothing. Yeah? If our exports to the US would halve, we lose 1% of GDP, 1% of our production. That's almost all the growth in the economy that is expected for this year. So instead of growing 1%, we would be flat this year as far as economic growth is concerned. Not a nice outcome. But a tariff increase in this magnitude would also be very negative for the US. It would drive up inflation, it would drive up prices, would drive up interest rates, it would decrease economic growth also in the US. And if you think back, Mr. Trump and also the billionaires that are financing him, they are very proud and interested in having the stock market in the US rise and having the economy grow. And we think this has not changed. So what can we expect? We expect certainly more threats, also threats of tariff increases, even the one or other explicit tariff increase. But my expectation would be as soon as this comes to a level where the equity market suffers, Trump, who does not want the equity market to fall, would pare back those ambitions, would be open for a compromise, as we have seen already in early February towards Mexico, towards Canada, towards Colombia. They were in place, or actually they were threatened for 3 hours to 24 hours, and then there was already some form of agreement so that he would pedal back, would compromise before real harm in the economy is being done. That would at least be my base case expectation. What does this mean for equity markets? We certainly expect more corrections, volatility, nervousness in the markets, that's for sure. But whenever then there is compromise, also a swift recovery in equity market prices. And this will be something that will be very difficult to time. I would not even try to do it. Just look at early February, markets going down, and with the first sign that a compromise is being found, snapping back, getting out and then getting in the right time. For me, it's too difficult. So the outcome probably would be what you anyway know. The long-term returns in the market, in equity markets, have been usually made with time in the market and not timing the market. And I think this will prevail. So maybe what we would all need in the times of Trump is maybe just cooler heads and not too much hectic in the portfolio. In this case, I wish us all well. Until the next time.